Yeah.
Good week.
Yeah. It's
Why we're so
the season of
feisty on
miracles.
We're feeling like winners, maybe.
Shit is screaming. Everyone feels like a genius. We already talked about that. That was just October.
Bitcoin,
Everyone got rich again in
everything,
October.
everything's
Everybody's
up.
brilliant.
Yeah.
Yeah. Good fucking luck betting against Christmas, where stock's doing this every day. This is a glorious, glorious Christmas pattern.
Yeah.
I like also hearing that Target's got every Friday's Black Friday. Nice.
Every Friday is Black Friday, so we just kind of tune in. I mean, they're basically going full Christmas. I think part of it is because they just had stuff left over from all the inventory things. These discounters still have like flat panel TVs and Christmas trees tucked away from 2021. From
Nice.
all the supply chain problems. So they dump them out early is part of it. The other part is we've just flattened the holiday. People just start shopping early, which is glorious.
Which they probably should, given shipping issues, right? You probably want to get whatever you need.
People got in the habit, and when have you met a good retailer that won't just kind of goose sales a little bit this week, and we'll figure out what to do next week later?
That's
if
right.
you can start it early, go for it.
That's right.
And
I can hear the music.
It's kind of every store. Our Walmart had stuff up they actually had their Christmas tree up. I had mine up October 25th, I think. And I did it only after I saw the tree in Walmart that was already up. And Walmart Encinitas celebrating Christmas, which is like people are still surfing. So we're getting going early out here.
It's getting in your mind.
And it worked like crazy.
Did it?
It worked like crazy. Oh my God. They had a 6-foot Santa that was straight out of the Uncanny Valley. Oh my God, is it alive? You shoot it at 3 a.m. type of toy that you would put in the house. And it's a Santa that's ho, $180, which is a great price for an Uncanny Valley Santa that you'd end up shooting. But the stores look great. This is what they're supposed to look like. Every Christmas, they kind of tell you what our business plan really is, because this is the way we think our model can make the most possible money and do the highest volume.
Right. Right. And who we're attracting, right?
Really.
Are we going for the same customers? Are we trying to go a little bit more up? What are we up to?
And do we execute? It's the entire defense of still going out to Black Friday, because the bargains are already, stuff's on sale right now. But you want to see what the store's trying to do. It doesn't tell you that much to visit a store and they're in the middle of a reset or something. That's limited. I want to see what they want to look like.
Yeah, I want to see the whole
having
thing.
It be right in a real actual store, as opposed to like on a tour with a bunch of analysts where it's this fantasy thing.
Right. Who's hosting Thanksgiving this year?
We are.
You are. How about you, Marcin? He bakes you or no? Nope.
I'm a guest.
Yeah. It's nice.
We've got a lot of wild card cousins coming into town, meaning like, the cousins you don't spend that much time with, but ittle be great
Is that
to
a
get
good
the
thing?
kids together. And
is it good? Or?
Not sure.
Yeah, okay. All right. That's the wild card. All right.
If it was a good thing, I'd call it a good thing. It's a wild card.
Okay.
Hey, it's going to be memorable. Probably won't be boring.
That's right.
Boring is the worst possible outcome. So
might not do it again.
Yeah. Right. Exactly. Maybe it could be another 15 years, but we'll see.
Where are they staying?
See. We're keeping an open mind. They're not staying at the house. They're gonna stay at a resort nearby. Yeah.
That's
you want a little separation.
Very
everyone gets their own shower. Everyone gets their own space, and
you don't have to go home, but you can't stay here. That's right.
Right.
The bounces refrain.
I even got Marcin to laugh.
I like that.
Rock and roll.
Don't it? All right. Well, it is Monday, November 11th. I heard that it's Christmas time already by Jeff Mackey. I'm Nadine Turman. It's Wall Street Beats. We're here with Jeff Mackey, Robert Marcin, Kevin Baker. The crew is in for you today, talking about Christmas, talking about the stock market, talking about crypto. Everything's on fire. We're going to start the day off here with Robert Marcin. Robert, I know you're going to be commenting on Select Water. So what are you seeing? Give us an update here of what happened.
Nadine, when you're a shareholder today, every day is Christmas with this rally. So Oh, I'm just going to dispel a myth and talk about a couple of stocks that make money in a bad energy environment so far, even though they're energy stocks, because sometimes the conventional wisdom sounds right, but it might not be as right as the soundbite suggests.
Sure.
So I own Select Water. I bought Chart Industries. Both stocks have had very nice runs, 40, 50% in the last few months, despite the fact that oil prices are in sort of free fall lately.
Right.
Gas prices recovered a little bit, but the conventional wisdom is you don't want to own energy related stocks when prices fall. And in the oil service field, you don't want to own them, especially because there's efficiency gains that are reducing demand for that business while the price falls. So
Right.
it's the worst sector of the stock market, has been because of this soundbite, oil field services. And yet, Select Water, an oil field services company, which was $7.27 on January 7th, when Herb Greenberg, our illustrious founder, wrote a piece for me on his Substack. Stock was 7, it hit 14. So the stock's up nearly 100% in 10 months this year. So what went wrong for the Bears? Well, there are companies that participate in growth areas of oil field services or energy infrastructure, and Select Water is one of them. They released a quarter on Thursday, and the numbers were very interesting. It wasn't an aha quarter where you go, "Holy shit, this thing is really working," but the
Uh-huh.
stock went up 20 or 30% to 25% that day because they suggested the aha quarter was going to happen in the middle of next year. And when
Okay.
this gets good, it's going to get so good that the stock could, over an 18-month period, double again from 14 if they hit my financial targets for 2026.
And can you remind people, I know you gave us a lot of notes here that you're going to be sharing with folks. What do they need to do to hit those targets? What is it dependent on? Is it execution? Is it, shedding of things? Is it cost reductions? What does it take to get there?
Yes. So they have a plan that would take advantage of a problem that exists in the U.S. regarding oil production. So we have. I mentioned this when I was talking about the stock from buying it at $10 and
Right.
$11, and it's that for every barrel of oil we produce 6 barrels of water. And the water cannot be reintroduced right back into the water table because it has trace bad chemicals and elements, and it's very salty. So it's not something that you could just put back into the rivers and lakes because it would contaminate things. So the oil industry basically just put it in obsolete oil wells. They just pumped it down depleted oil wells, and that
Mhm.
was fine for a decade until that started causing earthquakes in the
Yes.
areas where the disposal wells were. So now there's an effort to manage more environmentally friendly and try to create reuse purposes and recycling
Right.
purposes for this water, right? So you build pipelines and gathering systems in the oil fields. They're, they get paid by the big oil producers to do this. They get 3-year, 4-year paybacks and 5 to 10 year contracts, and the water that comes out of the oil wells isn't price sensitive to oil, and it grows every year because every year we have to drill more square footage to keep the production up, and the water cut keeps rising. It used to be 4 barrels, and it became 5 barrels. Now it's close to 6 barrels. So the water's becoming a bigger problem, and these guys have a system. They have a gathering system, but then they also have a chemical treatment division, and they have a water delivery system. Delivering fresh water is very different from harvesting and recycling and treating produced water.
Sure.
So these guys go to Exxon and they say, look, you got all these guys doing all parts of this water problem you have. We'll do everything for you. So
Okay.
if you
So one
own the
stop shop. One
if
stop
you
shop.
if you own the produced water, you should be able to bundle the chemical treatment that makes it reusable for refracking, and then the delivery system to refract it, which is the water services business. So, in a way, the fact that they have this big pipeline system all over to the Permian Basin could help them take market share in the other two divisions. And if that happens, the stock becomes a growth stock. And whether oil prices are 60 or whether they're 80, it doesn't matter. And when growth guys discover a value stock, Katie bar the door, because this thing is trading for, 4 times my EBITDA target today for 2026. And, they're supposed to make over, I'd have them making $1.25. So it's 10, 11 times earnings. I'm not going to make the most money selling this to other value guys, but I can make it when growth investors that have benchmarks, that have oil energy related companies in them, they're not buying or Chevron. They're not buying, they're not buying Schlumberger or Halliburton. They don't grow. But when this company gets it together and starts growing double digits on the top line with massive margin expansion and has massive earnings growth, then we could see 20 times earnings for this stock in a sector that's 10 times, just because it's such a precious commodity, a growth company in energy and oil field services.
I know you're talking for 2027, a $400 million EBITDA. What does cash flow look like? Do they have to use a lot of CapEx to get that EBITDA? What kind of business, just so people understand cash flow versus, profits?
They are spending heavily in the one business they own. It is the capital intensive business, the pipeline infrastructure business. However, the other two divisions provide a significant amount of free cash flow. And the company itself, its maintenance CapEx as a percent of revenue is very low. So they're investing very heavily in this growth engine of the company, and they're still generating positive free cash flow.
Okay. So maybe in the notes for subscribers, we won't give it all away, but for notes for subscribers, maybe tell people of that 400 million, how much they have to spend. It'd be kind of interesting for folks, I think. So thank you, Robert.
Maintenance
we won't give it all away on a free show. All right, Jeff, take us through Amazon. I know we talked about it last week, and I love your picture today with his top hat. So tell us about Top Hat.
Yeah, Lord Bezos is doing pretty well. We talked last week about Amazon. Great earnings. They do so many things, and they do them all really, really well. So they kind of report whatever they want. But the nuance was good. The vibes were good. But what we have is Bezos on the inside. Now, a year ago this month, he filed to sell 50 million shares. Gone through it pretty fast. He did a little bit as a stick you to the state of Washington, moved to Florida where there is no state capital gains, and just started dumping. Dumped it in February. You can see kind of on the man's right hand there with a little top hat. He's happy. He's happy. That's what I was trying to convey, is a happiness there.
Yes.
Accepting of
he
the
is.
good graces.
His abs are happy.
He's totally happy because he sold 25 million shares of his company at a cost basis of nothing. They were founders' shares. In July, at the top of the hat there, he squashed the shares at 200. Now, last week, we talked about, this is going to be a cap on the stock because the earnings were good, but they weren't like super hyper good. And you and I talked about kind of the technical setup. It's a little overbought, and we had that resistance. Well, it broke above the resistance. Now, so did everything else. But why it's notable is this, because Bezos came in again at 200-ish, where we were talking about, and he started dumping, and he's liquidated something like $8 billion worth of shares, which buys you a pretty good yacht or two. But more to the point, he's about 40 something, 45 maybe. It'll depend on what we see from the filings tonight into this 10.5B that he filed, and so he's almost out of shares to sell unless he refiles again. That'll remove some resistance. And the most important thing, this is the hardest market, or the easiest market really in the world to make money. Just be long something, you feel brilliant. Really hard to stay long. And with a company like Amazon that you really just kind of want it to be in your portfolio, and you always feel like you should own it on some sort of dip, you don't get this many nice breakouts. Where we had resistance before is now support. If it holds above 200, you stay long this. You don't really sweat it if you're a trader. As an investor, you should always kind of own it. Well, you might as well own it when it's on the cusp of going up. So this is a pretty meaningful technical breakout. Resistance is going away, and I think it's going to be a decent Christmas. So, is it a pound the table buy? Nope, but I'm already long, and I'm certainly happy about it now. And I'm looking for reasons to stay long
telling
stocks.
People, like, do you hold, and what are you looking for? And you're saying technicals could move it up, but also maybe tell us a little bit about consumer discretionary as a group. Near all-time highs going into earnings. So what are you thinking about the group positioned? There's the stocks and the fundamentals, right? So fundamentals could be one thing, but the stock's something else. So what are your thoughts on that?
I think we're still in a stock picker's market, but you're going to get, we're also in say anything. Under Armour came out
Right.
last week and they basically said anything, and we kind of had a vague plan and we're not dying immediately. And they got like 30% out of that. That was a great sell. And if you've been long Under Armour for a long time, holy cow, that's
God
terrific
bless.
because this isn't really, yeah, God bless, and this is your exit, and people are going to be taking it. I'm not sure how Lulu's going to do because we're going to get to a point where this company's $70 off where it bottomed at post earnings. It's just below where I sold it originally, so I'm about to kick myself in the ass for collecting the taxes on it. But beyond that, there is China exposure there. We are entering kind of a wild card period, and I'm not positive they had such a great fall. So do I want to be long, these comeback stories, these bouncers? Not necessarily, but boy, we've gotten really healthy, really rich, very fast on a lot of these consumer plays. They're kind of overdone. But it's, again, the hardest thing to do right now is stay long. Draw lines underneath them, draw support where you can find something like that 200 on Amazon. That's where you sell. And otherwise, just try to ride it because this is when you make money.
Okay. Well, thank you. Now we're going to get over some technicals with Baker. Baker, what are you saying? I know you're going to talk about one of the tech names that we've been talking about lately because it hadn't held up like other tech names. So what do you think about Microsoft now?
Well, this is what it looks like when stocks dive, and I unfortunately couldn't get through the legal morass of the artist formerly known as Prince and have a mixtape to go with that.
Okay.
But I make sure that I study history and at least don't let the same dogs bite me twice. And that's the case with I literally have studied, hundreds of stocks when they roll over. And this isn't textbook, but it looks pretty good. This is what it looks like when stocks dive. So you have this is the left shoulder, if you will, and the volume's okay. I'm not dazzled, but there's a clear uptrend. It stays above the moving averages, and then it comes to this high here, the head, if you will. But look at the volume. It is so unenthusiastic, and I think I know why. I mean, it's you have the AI
Right.
for OpenAI investment. It's the number 3 name in the S&P, so you got to own it. If you're benchmarked at 6% of the S&P, but the enthusiasm is clearly not there. I'll get back to this discipline, but then this is what happens when you rally feebly off this low here, very low volume, and then the volume picks up on the downside again. And it's just classic. And it just means that, at a minimum, you got to be cautious. And in my case, my sell discipline kicks in. And this is one of the great things about Wall Street Beats. We talk about, actual tactics. And I at least talk about how to sell. Every service I use talks about how to buy. They don't talk about how to sell. Well, it's 50% of the equation, and it's where you ring the register. So here is the close back in August 5th at 395 day moving average. And my discipline would say sell a third at that point and just, get out of Dodge. Now, back here on November 1st, we saw the 50-day come down through the 200. And that is the second part of my sell discipline. I would sell a second third at 410, so the average is 402 and change. And this 200-day moving average here is going to be rolling over, I think, pretty soon. Sell a third, and I think there's just other ways to make money. And I think this is going lower.
Okay. Well, thank you on that one. And I know you have another name here that you wanted to talk about.
Yeah, and what I like about Wall Street Beats is we talk our book and we're upfront about it, and we admit our mistakes. And my discipline is I own the 10 best ETFs I can find. And I thought that Sprott Physical Platinum, SPPP, would be one of them. It just isn't in the top 10 anymore. I've got other things to do. It's down 11%. It's my only loss. And so I took it behind the barn and shot it and raised some cash. And I'm going to be going on to do some other things and I don't know if I'm going to get a chance to do this, but we talked about this before. I owned this, 20% ago. It gapped up here very nicely. If it comes close to this breakout level below 59 some odd, I'm going to be there. I like to buy things within 5% of a breakout. Charlie Peabody, our colleague, is his Wells Fargo is the number 3 name in this portfolio. The banks are clearly going north. Apollo is the number 1 stock in this ETF, and I think this is going north for a considerable period of time.
And just so people know, this is the KRE, or which one is this one?
This is the KBE.
KBE. Okay, thank you,
Yeah.
KBE. So
Apollo,
folks
Johnson,
know,
Wells
right?
Fargo are the
Got
1,
it.
2, and 3 names.
Got it. And when you think about this, so you've entered this already, or you're going to add to it. You had it before, now you're thinking of the add. That's how you're.
It's 8% of the portfolio. I'll top it off to 10 if I get a chance, and if I don't,
Okay.
then I'll just let it run.
Okay, great. Well, listen, we brought you banks, we brought you platinum, we brought you here Microsoft,
Christmas. We brought a
Amazon.
little bit of Christmas,
We
Nadine.
brought a little bit of Christmas, which I think a lot of shows can't talk about, and some water. So we're bringing it all to you today. We'll be catching you back tomorrow. But again, Monday, November 11th, 2024. And good to see you. Check us out on Wall Street Beats if you want more of the information, especially those data points from Arson. So take care.